Hi everyone, thank you for attending again. So today the session we scheduled is centralized finance. Maybe we are all curious to know what is decentralized finance and how it is different from our traditional banking system and how it is special in terms of crypto or blockchain technology. So we have our speaker Jinesh in the meeting, and just to give a background, he has this technology and also business background. He has done his engineering from Nirmala Institute of Technology, one of the top Gujarat universities, and then he has also done his MBA sponsored by Asian Development Bank, and he's pursued his MBA with Asian Institute of Management. He worked in different companies like Infosys, HDFC, Globe Telecom, Costco Capital and in Philippines. And he has a good experience in the mergers and acquisitions area. And as of now, he has completed CFA level 3, and now he's working as an investment banker, managing a good amount of portfolio in last 4 to 5 years. Okay, with this short introduction, I will hand over to Jinesh. Jinesh, thank you for accepting our request and spending your time to conduct this session. Over to you.
Uh, Thank you, Chetan. Thanks for a nice introduction. It has been my pleasure to be part of the IIG group and to get a lot of info and a lot of knowledge from the group and from you personally and other group members like Dhruve, Jay, and other people in the group. So as we have discussed that we'll kick off this learning or knowledge transfer session uh, first with Defi and then later with a few other interesting topics as well. So today we'll start with Defi, which is also called decentralized finance. So what to expect in this presentation? So here I will give a brief view on the investment thesis for the next decade within the crypto and within the overall investment framework. Then different categories within the crypto ecosystem. Then we'll explore DeFi ecosystem. Within DeFi, we'll look into DEX, that is decentralized exchanges, stable coins, lending and borrowing decentralized applications like Aave and Compound, and a few other applications on DeFi, which are called synthetic assets. We'll also look into that. So here is my investment thesis for the next decade. Uh, we have seen that corporates have been outperforming mom and pop stores over last few centuries. So corporates have a better shelf life. That is, corporates can live as long as 100 years. ITC, Indian Tobacco Company, more than 100 years old. Coca-Cola is also more than 100 years old. So these are the benefits of corporates over mom and pop stores. Corporates can scale, mom and pop stores cannot scale. Corporates create more value, mom and pop stores create limited value. We all know that corporates pay much lesser tax than a mom and pop stores. Even Warren Buffett acknowledged that fact that its corporate entity Berkshire Hathaway pays far lesser tax percentage compared to an individual or compared to a mom and pop stores. Now, this has been kind of getting challenged by DAOs, which is decentralized autonomous organization, which enables Uniswap, which enables Maker, DAO, and many other applications which are running on the on in the crypto sphere. Then uh, uh, something which is more broader or more bigger than DAOs are decentralized protocols. Decentralized protocols are Ethereum, Bitcoin, or the layer one blockchains, Cardano, Polkadot, whatever BSC, Binance Smart Chain, and all the first layer protocols which are creating value have a higher shelf life compared to
Jinesh,
yeah.
Jinesh,
Am I
have you
yeah?
moved to the next slide? I can't see it. At least it is not reflecting in my screen.
I'm on the second slide.
Is it?
Investment.
Ah, okay.
Yeah, is it good?
Yeah, I thought maybe you are in different because layer two protocol, the layer one protocols you are talking about, and I didn't see
Yeah,
that. That's why I said.
yeah. So the layer one protocols are mostly the decentralized protocols, which have a higher shelf life, scalability, and value creation compared to corporates and compared to DAOs. So if we look at the value creators for humans, initially humans started investing in a perishable investment like food grains. So food grains were the first investment for the human. Food grains and the meat were the first investment product for the human. Then later on, people moved to local blacksmith shop, which are unscalable investment, or we can also call it as a mom and pop stores. From that point, we further moved into a closed and centralized corporates like East India Company. East India Company, as we all know, ruled for more than 100 years, and it existed for more than 100 years, trading tea, opium, and even minting currency. Uh, then currently we have closed and centralized corporates like Facebook, which has a huge network effect and which has more than 1.2 or 1.3 billion people on its network, which is much bigger or almost equivalent to a nation state. Uh, Further, the value creation have happened through open and decentralized systems like Linux, Gold, Internet, and even human languages. So, human languages are the highest form of open, decentralized value creation that has happened for the humans. Without languages, we all know that humans would not be able to communicate, would not be able to organize and live on this planet. So if I put Bitcoin and crypto industry, it will be somewhere between the Linux and internet. So it is open, decentralized. When I say open, it means anybody can change the code, anybody can view the code and modify it and build upon it. When I say decentralized, it means there is no headquarter. Facebook has a headquarter. East India Company had a headquarter. Gold, Linux, Internet, they don't have a headquarter. Bitcoin doesn't have a headquarter or a CEO or a single owner. Same is with the Ethereum. Ethereum has the founder teams, but it is not based in a single country. Uh, it is not a domicile of any single jurisdiction. So this are the factors which will create more value compared to the corporate. So if corporates were the biggest investment for the 19th and 20th century, for 21st century, open and decentralized protocols and DAOs will be the biggest investment for this century, or the biggest value creators in this century. So crypto categories, within the crypto, we have digital gold, which is Bitcoin. I just given my portfolio allocation within the crypto category. I would have maximum allocation in Bitcoin within the crypto space because it is the longest running chain. Uh, then we have uh, within after Bitcoin, we have other smart contract chains like Ethereum. We also have other smart contract chains like Polkadot, BSC, ICP, etc. We have privacy chains, which is Monero and Zcash. We know that Bitcoin is pseudo-anonymous and it is not 100% private. People can see what amount is being sent. People can see from address A to address B where the funds have been sent. These all things are visible and auditable on a public blockchain for Bitcoin, for Ethereum. So they are pseudo-anonymous. Monero and Zcash are 100% private privacy chain. So nobody can see from which address to which address funds have been sent and how much amount or what amount of funds have been transferred. So those are the two another categories, or those are the two possible products within the privacy chain category. Defi lending is something similar to banks, where you deposit, where you borrow. MakerDAO, Compound, are examples for that. Defi DEX are decentralized exchanges, where you swap your currency or assets from one token to another token. So, for example, we use Western Union, right? We use Western Union to convert from euro to dollar, or from Indian rupee to dollar, or from Philippine peso to dollar. Uh, so something similar is done on Uniswap and QuickSwap. So you convert WBTC, which is Bitcoin on Ethereum, to MakerDAO, from MakerDAO you convert it to Uniswap. Unitoken, from Unitoken you convert to NXM, which is Nexus Mutual Insurance. Defi insurance is another category. Uh, Now, as all of you know, that all these platforms or all these DApps are very new, and they are just raw codes, and all the codes can be hacked. So parallel to this ecosystem, DeFi ecosystem, insurance has also has evolved. So there are now insurance where you can take an insurance against the app where you are depositing or borrowing your funds from. So let's say if I deposited three Bitcoin or three Ethereum in Compound, and I left my three Ethereum, which is let's say around $6,000 on Compound, and it is going to be there for 1 or 2 years, I might buy an insurance against the hack of Compound protocol or Compound DApp. So if a Compound DApp gets hacked, Nexus Mutual, which is an insurance app, will pay me if the hack happens. And all these things are on chain. Most of the time, what I have heard is that all these insurance have been settled within few hours of the hack or few days of the hack, because all the data are on the chain. It reduces all the verification and audit required for paying out the insurance. Then the another category, or the eighth category, is shadow markets, or what I call DeFi Dabba market. Dabba market is a common term used in India for the shadow market. It is similar to, if you people know, there are shadow markets for stock in India, and even in US, and even in I'm sure in the Germany it might be existing. So these are the also this markets are used for a prediction or gambling. So let's say if there are football match or EPL or IPL is happening, and if someone wants to bet on Mumbai Indians versus Kolkata Knight Riders, there are these prediction markets where one can go and bet on those things. And again, all these things are permissionless. All these things are censorship resistant, and they are just unstoppable codes. So no jurisdiction can stop it, or no authorities can bring those codes down. Very similar to Bitcoin. Another
Jinesh,
category. Yeah,
Jinesh, sorry to
yeah,
interrupt. Maybe you
sure.
might have to adjust your mic because your voice is not that clear to everybody.
Okay. Is it audible now?
Yeah,
No,
we
not yet.
can give it a try for a few minutes.
Okay.
Yeah.
So another infrastructure is, or the category is the oracles, which provide external information to the blockchain. So let's say what is price of Apple, or what is the price of Infosys stock. Those informations are outside to the blockchain. So Oracle does that job of providing external information to the blockchain. After that, another category is what we have all heard about, NFTs, that are non-fungible tokens. So NFTs are used for various purposes, for art, for virtual real estate, um, for gaming, like crypto kitties or crypto or XC Infinity. And then obviously there is crypto art, where digital art is registered on blockchain as a registry, and NFT is being used as a sale deed, or what we call as a dastavez in India. So, Chetan, is it audible?
Yeah,
Hello?
this is better, but maybe little echo is there. I'm not sure whether it's the mic, or are you speaking to the laptop? I'm not sure.
Mhm.
If you can switch your headphone, if there is an alternative, maybe that will work. Yeah, there is some echo, it seems. People also saying.
Let me try another headphone.
Yeah, thank you. Also, meanwhile, audience can also post their questions. Already, I can see the first question regarding the topic. If you have any question on the particular slide, maybe we can address it at the end of the presentation. Please feel free to post the questions in the chat. And of course, you can always welcome to ask at the end of the session.
Hello.
Yes, Jinesh, you are audible.
Is it good or the previous one was better?
I think previous one was better.
Hello?
Yes, Jinesh.
Is it good?
Yeah, I think we can continue.
Okay. Okay. So, yeah, so these are the 10 or 11 categories. These are not just limited to 10 or 11 categories. There can be more as things are evolving. and there can be more categories, and within the categories there can be another subcategories as well. So yeah, this is how we have evolved from in God we trust to in government we trust to now in algorithm we trust. So this is not just applicable to Bitcoin. This is also applicable to anything related to finance, and that's how the Defi has evolved. So practically, we are trusting algorithms compared to trusting the governments or trusting the corporate. So when internet evolved, the protocol layer, which was internet, was at the bottom, and then there were chat applications like Netflix, Facebook, Amazon, and Google. So that those were the application layers. Whereas for the blockchain, it is completely reversed, and the value capture is going to happen at the protocol layer, and the application layer will be much more fragmented. So there will be very thick protocols, something similar to Bitcoin and Ethereum. So if you look at the market cap of crypto, it's somewhere around $1 trillion. Within that $1 trillion, $600 billion comes from Bitcoin, and another $200 billion comes from Ethereum. But if we compare this thing to gold, gold is around $13 trillion. But then there are so many jewelry shops, there are so many brands which are catering to the gold. I'm sure each town in India will have a gold market, silver market. Same goes with in the international markets as well. There are n number of jewelry shops where you can which adds value to the gold as a protocol. So something similar will happen to Bitcoin and Ethereum, or it's happening to Bitcoin and Ethereum. There are at least more than 500, 600 apps which are on Ethereum, which are adding value to the Ethereum. And Defi is one part of that ecosystem. So the use cases of crypto and Bitcoin. So we'll start with the basis of the Defi or decentralized finance is a stable coin. So there are three flavors of stable coin. One is unregulated stable coin, which was the first one, USDT. All of you might have heard about Ether. It has got a lot of bad name because of its possibly false promise of being 100% collateralized by dollar. It is unregulated and it is favored by people because since it's unregulated, it cannot be platform anyone. Whereas its competitor USDC is a regulated stable coin, and anybody or anyone can be deplatformed if US government wishes to do so. Again, the benefits and pros and cons of both of them are there. USDT, we don't know whether it's fully collateralized by a dollar in a bank. But with USDC, we can rely on the audits and the guarantee of US government since it is regulating it that each dollar USDC dollar on a blockchain is backed by a dollar in a bank account. Then there is a third category called algo stablecoin. MakerDAO and its product called DAI were the first product of algo stablecoin. DAI is over collateralized, so for every $1 of DAI, there are at least $2 worth of collateral backing it in an algorithm. Flex is the most advanced version of the algo stablecoin, and so in the first two categories, USDT and USDT, it is the CEOs who are deciding whether they want to keep 100% collateral or they want to put less collateral for every dollar on the blockchain. But for the Flex, it is the market which is going to decide whether each Flex dollar is backed by 100% collateral in the algorithm, or it is backed by less than 100%. So let's say if there is $100 of Flex, market will decide that only $70 worth of it is backed by crypto assets like Ethereum and other crypto assets. Whereas in the first and second case, it is the CEOs and the monetary committees which decide that for every dollar on a blockchain, whether there is going to be an equivalent amount of dollar in the bank account or it's going to be less than that. So moving on to the second category, which is DEX, decentralized exchanges. So Uniswap was the first decentralized exchange. This is similar to, we can call it as a Western Union for blockchain. So here you can swap 8,000 or 10,000 different assets or currencies on the go. So here you can, let's say, swap from Ethereum to USDT just with a click of the button. And it is permissionless. It is anybody can create a token and anybody can add a liquidity to it. So let's say we can create an IIG token. That is what our group's name is, right? Indians and Germans. So we created an IIG token. We added into the Uniswap pool. So anybody can convert that IIG tokens into US dollar and vice versa, can convert US dollar into IIG token. Only thing is there has to be some liquidity provider, and those liquidity providers are incentivized by giving them some fees, by giving them the uni tokens and many other incentive mechanisms. So this is also called an automated market maker. So here you don't need any permission. You can just put up your tokens and you can swap it. Same goes with swapping the tokens. There is no KYC. There is no censorship resistance. You can convert your Ethereum into USDT. You can convert your USDT into DAI. Whatever you want, you can swap it. Because this is running on Ethereum, it has a bit high level of gas fee. But there are another different versions of Uniswap called QuickSwap, which is running on layer 2 called Matic, where the fees are really cheap and anybody can, even like for $10 you can swap whatever currency or whatever tokens you want to swap into. Uniswap last year was doing like 0.0001 trillion. Today or just few days back, it did around 0.3 trillion in trading. So this is a huge amount of growth in terms of volume, and maybe over time it can even go beyond the trading volumes of what Nasdaq or Bombay Stock Exchange are doing. Just to note the fact, on Bombay Stock Exchange there are 8,000 stocks listed. Bombay Stock Exchange is already 100 years old, more than 100 years old. On Uniswap, which is just 2 or 3 years old, there are already 8,000 tokens listed, and all of them got listed without any permission. To list on Bombay Stock Exchange or NYSE or Nasdaq, one has to go through a lengthy process. But to list on Uniswap, one just needs to run a smart contract. Moving on to another category, it is MakerDAO. So MakerDAO is a similar to a central bank on a blockchain. So initially, central banks used to work in a very simple fashion. You put a gold, and central banks will issue you a paper currency. So you put a 1 kg of gold, they will give you around equivalent amount of pounds in paper currency. This was done because carrying or transacting in gold was difficult, whereas transacting with paper currency backed by gold was easier. So what MakerDAO did was something similar to what central banks did 500 years or 400 years before. And here you deposit Ethereum. Ethereum is your digital asset, and they will give you DAI, which is a dollar-backed stable coin. So $1 real is equivalent to one DAI. And when you pay back your DAI, so let's say you paid your 100 DAI debt, you will get back your Ethereum collateral. This is as simple as that. There is nothing else which this algorithm does. And this this project MakerDAO is already worth $3 billion, from around $3 to $4 billion. So this is how one can create algo-backed stable coin. The second application or the part of the Defi infrastructure is lending and borrowing apps. These are very similar to the banks. Banks like Muthoot Finance or other banks where you deposit gold as a collateral and borrow Indian rupee or whatever the euros as a loan, as a borrowed amount. So here in a bank, the whole process is being done by managers, from loan application to the loan management to everything else is being done by humans and by managers under the corporate entity. Here, everything is being done by algorithm. There is no loan application. You just deposit your collateral, which can be in Ethereum, it can be in WBTC, Kyber network tokens, or anything else. So here you can see that I borrowed around $400 by depositing around 5 Ethereum. These slides are at least 1 year back. So at that time, Ethereum was less than $500. So here, the loan to value ratio and everything is managed by the algorithm. You can see here the different interest rates, 3%, 4%. Now just think, this is the kind of power which Defi gives. Anyone in India, anyone in Brazil can borrow at 3%, 4% interest rate. Every one of you are from India, so you know that even home loans are somewhere around 7%. So with this kind of asset, crypto asset, anyone from anywhere in the world can borrow at 3%, 4%. And this is also a win-win situation for people in a low interest rate zones or regions like Germany, the US, Japan, where interest rates or savings rates are less than 1%, 2%. So anyone who's lending at 3%, 4% to someone in India or Brazil will also be happy, and his funds are going to be 100% collateralized. So here, just for an example, you can borrow in variable rates, in a stable rate. Mostly 95% of the loans are in a variable rate compared to fixed rate or stable rate. So you can borrow in algo-backed dollar stablecoin, or you can borrow in a regulated dollar stablecoin like USDC or PUSD. So this is the collateral composition. Orange part is the Bitcoin part, WBTC, and the gray part or the black part is the Ethereum. So my collateral, I need not just put single collateral. It is similar to, I don't have to put only gold as a collateral. I can put gold and silver as a collateral and borrow against it. So this kind of flexibility is not there in a traditional finance, or even if it is there, it comes with a cost and it comes with a time. Here it's just with a click of the button. So 1 year back, this Aave protocol had done a business of 47 million. And again, this startup is just 2 or 3 years old, and it's based in London. Right now, it is more than I think around $10 billion. Maybe other experts in the group can correct me if I'm wrong. Then another important infrastructure of Defi is BlockFi, which is a centralized Silicon Valley based startup. So I might not call them Defi, but still it is an important part. It does the same thing which Aave does, but it's it's more on a centralized approach. It is very similar to a Citibank, or it is a very similar to ICICI or HDFC Bank, where one deposits the Bitcoin, gets an interest, and that's how they operate. Another important part is InstaDF. So InstaDF is something like an aggregator. It aggregates or makes things easy to deposit and borrow across different lending and borrowing apps like Aave, Compound, and Polygon, or Aave on Polygon. So again, this slide is from last year. They were doing something around 8.4 million last year. Today, I think their business or the total value locked is somewhere around $5 to $6 billion. Coming to synthetic assets, as I told, there are in the physical world there are concepts where you can buy Google shares or Twitter share or Apple share without routing your trade to a normal stock exchange. So this is called a Dabba trading. This is So in India, the Dabba trading is huge. It's almost equivalent to the volume which is being done on Bombay Stock Exchange and NSE, BSE, and NSE. Now the same idea is being replicated on a blockchain. This thing is called contract for differences, CFD. So where you bet with a counterparty saying that okay, Apple stock will go from $1,000 to $1,200. So whenever it goes to $1,200, you cash out the $200 profit, which is called contract for differences. You don't have to pay upfront. You just profit, or you just get the differences in the trade. So instead of going up, if the Apple stock goes from $1,000 to $800, you pay the loss $200 to a broker. So it is something similar to brokers running the books instead of running the trade, instead of trades being performed on the exchanges. So here it is the same thing. The only difference is the whole ecosystem, the whole trade, instead of running on the books of humans or a brokers, it is being run on a blockchain, on a permissionless blockchain. So anywhere from the world can buy a Google stock or a Twitter, get an exposure to a Twitter stock. So these are the apps which are enabling that kind of innovation. In most of the countries, the CFDs are not legal. If you will read the last line, so this, because all these trades bypass the normal taxation, and that's why they are also considered tax efficient, and that's why most governments don't like this kind of trades, or the trades which bypass the normal government eyes. But again, blockchain is enabling all these things because there is a need, there are the users, and there are people who want to use it. Okay, so this is the future of finance. Before, this is how the banking started. Initially, 500, 700 years back, in person we used to trust. So there used to be this lala in every town. Hello.
Recording in progress.
Yeah. So there used to be a lala in every town from who used to do a lending and borrowing business, and the person had to trust that lala with respect to its collateral. If he runs away, then your collateral is gone. Or then came the organizations, then came JP Morgan, then came Goldman Sachs, then came HDFC, ICICI, SBI. So instead of trusting one person, we started trusting organizations. So no matter if your branch manager goes, you are not worried. If he gets transferred, you are not worried because you trust JP Morgan, you trust ICICI Bank. So that was a higher level of trust that we started putting in. And now there is another layer to it. Now we trust algorithms. We are already doing this when we do a transaction with an ATM. We are already transacting with an, or we are already trusting an algorithm. We are already trusting a machine. And as we have seen that whenever we have migrated or have increased our trust level, interest rates have fallen. So if you would be with a single person organization, a Lalaji in your town, your interest rates will be higher. But if you deal with the organizations like SBI, ICICI, or JP Morgan Bank, your interest rates will be lower. But now, as I had shown you that if you trust blockchain, if you trust algorithm, and if you have a digital asset, anywhere in the world you can borrow at 3%, 5% interest rate. So this is where the future is going. Finance is getting less and less, or I would say finance is getting more and more to be trusted or to be relied on algorithms and on the blockchain. So as all of us know that US dollar system is fragile, it is being weaponized and it is being used against a lot of countries. Also, we have known that banking has become an innovation free zone because of a lot of regulations and because of being too much close to government. Compare that with permission blocks or permissionless blockchains, open blockchains, which is where the young India and world is building upon. So we have seen so many applications coming up on the DeFi and within the DeFi ecosystem that we have not even in this presentation, I would have not even touched 10% or 20% of those applications. And while we are discussing Defi 2020, there is already Defi 2021 which is happening, which is more beyond Ethereum and Binance chain, and which is much more interoperable across multiple chains. So just to give a hint of that, there is a project called 4Chain. So 4Chain is very similar to Uniswap, but it is between different chains. Uniswap is only for Ethereum. QuickSwap is only for Matic. Similarly, there are DEXs for Binance Smart Chain, but all of them are very specific to those chains. But now 4Chain is completely interoperable across Ethereum chain, Bitcoin chain, across Binance chain, which will give rise to the next level of Defi, or we can call it as a Defi 2021. So yeah, I guess that's it. Thank you. And any Q&A?
Thank you, Jinesh, for a very good session. Now we will open the floor for Q&A. Obviously, the first preference would be anybody is unmuting themselves and asking question. Otherwise, we have some questions in the chat. Some are answered, but we will also go through them again. So, to the participants, any question you would like to ask?
Hi, Jinesh.
Yeah, hi.
Yeah, thanks, man. Thanks for the session. Yeah, Jinesh, can you just tell some of the risks we see in the DeFi aspects? What's going on from a couple of weeks with this one chain called Titan, or I don't know. I don't remember. They just
Iron
disappeared
Finance.
with 2
Iron Finance,
billion.
yeah.
Yeah.
So Titan was similar to what I mentioned about Frax. So Titan is an exact modification of a Frax open source code. So let me just get back to that slide. this one, algo stable coin. So FREX was the first advanced algo stable coin after DAI, which was partially collateralized. And Titan copied that code, and they made some changes and were experimenting with it. And I think Mark Cuban got part of it. He was also experimenting with it, and somehow the bank run happened, which is very similar to all the bank runs which we have seen in a traditional world. So in traditional world, we call it as a under collateralized or a fractionalized banking system. So for, let's say, for every $1,000, there is not an equivalent of $1,000 of gold or a deposit in a bank. So if all the depositors goes and tries to withdraw their money at a single time, bank is going to go bankrupt. The same thing happened with Titan. All of the people started redeeming their tokens, their dollar stable coins into another currency at the same time, and that's when the Titan uh, price crashed from, because algorithm started issuing like billions and billions of new Titan tokens, and algorithm did what it was supposed to do. So whenever the redemption happens, it will give a it will issue a new Titan share. But it was never assumed that all of the people will go and do the redemption at the same time or within the few minutes or few hours. And that's when the like billions of Titan tokens were issued, and that's how the price of Titan crashed from, like, I think somewhere around $60 to almost zero.
Mm. Yeah, thank you, thank you. Yeah, what I feel with the DeFi is like there is an opportunity and also there is an equal risk. I feel like because yeah, I see a lot of projects like from the beginning I never invested in any DeFi, to be honest. It's I felt it. Of course, you can make money and also you can lose money in the same way. Yeah, but the hard part is like who will verify this their code, because they can introduce any kind of bugs there, and yeah, they can just steal your money, whatever. That's my opinion actually. Yeah.
Yeah, that's correct. That's a risk, a big risk of the Defi, which I call it as a governance risk. So if the team is not good, if the code is not audited, then there are good chances that insiders might only hack it and steal the money. So again, it's better to like experiment with a small amount and see how the things are going. And yeah, only once you are comfortable, it's better to uh, get a bigger exposure.
Yeah. Okay. So did you try this new launch, which what happened, this Insta app, which you also mentioned? I was cleanly looking into it because it's like a dashboard with all the DeFi
Yeah,
like a middleware application, right?
exactly. So I had used InstaD app like 2 years back,
Mm-hmm.
and then like the Ethereum gas fees increased very high, and because they were not fine tuning on the gas fees, so I didn't I left. I mean I stopped using it. Uh, but yeah, I'm like very familiar with the InstaD app, like all the new features they have been adding and all the new chains they have been or protocols they have been supporting. Uh, so yeah, it's one of the very fun projects. The only downside of that was it had a high amount of gas fees. And then they have enabled it with Matic Polygon, but then I have my own concerns with respect to Polygon, so I don't want to put a lot of funds on the Polygon. So I'm right now just observing and just exploring those projects instead of putting any sizable amount on those projects or within those ecosystems.
Mm-hmm. Yeah. 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 Thank you. Thank you, man.
Janesh, fantastic session. Thank you. I was reading the interview of Stanley Druckenmiller, and where he said that after he saw that once Bitcoin received and kind of retraced back, and he saw that 86% of the people are still holding it, the OGs basically, and he wanted to buy a lot of it, but he wanted to buy about 200 million worth of Bitcoins, and all he could do was 20 million worth of buying actually, and that also took him like a couple of weeks. So that's what he said in his interview. And that coupled with the fact that a lot of the volume that you see on the market is mostly denominated by stable coins, either USDT or one of the Binance chain coins. So what's your view on price discovery, given that the liquidity is not really that great, and most of the liquidity is actually provided by the stable coins?
So stable coins are just the enablers. Stable coin does not play a much. I mean, I would not say they even if they were not there, liquidity situations will not be that different, because the situation is that there are a lot less sellers than the buyers. So that is the current situation right now. And plus, a lot of people who are not able to buy in that quantity they want to buy, they are migrating to futures and options. So futures and options are especially futures are practically paper Bitcoin, and through that they can get a good amount of exposure, unlimited amount of an exposure, without worrying about the liquidity situation. Plus, I think this this thing will evolve over a time, and it will always be a problem to buy a big quantity. It is a problem with gold as well. When a central bank tries to buy gold, it disturbs the whole gold market, whole physical gold market. The same happens with the physical Bitcoin delivery market or the spot market. When big hedge funds will try to buy, it will move the market. And as far as USDT and other stable coins are concerned, if you look at the market cap of USDT compared to the whole crypto market cap, it is a small percentage. So crypto market cap is around $1 trillion, and USDT is somewhere around less than $100 billion. So it's less than 10%. So I don't think it will impact. And there are, like, it's already known that USDT is only backed by 5% of dollar. So I don't think like it will make a bigger dent if news comes out that USDT is backed by only 1% of dollar and 99% is some unknown assets. Yeah.
Yeah, but that also talks about the liquidity itself. On liquidity on one hand, and all the volume that you see is also mostly stablecoin denominated, right? So that also points to the question that whether the price discovery is really there, because a lot of it is actually denominated against stable coins, and that is so to say the funny money, right?
That's partly true, but again, compared to, let's say, 2017, there are a lot of more avenues which have happened. Let's say there is already on ramp, like in India there is WazirX, even in US market there is Coinbase. So that's where actual fiat money is going in. And then there are also this future contracts, perpetual future contracts, which is also leading to a price discovery. So your point was had a valid this thing weightage in 2017, where trading avenues were very limited. But in 2021, like, there are at least 10 times more trading avenues which are there, or maybe I would say 100 times more trading avenues which are there compared to 2017. So to manipulate 5 or 10 trading avenues is easy, but to manipulate 100 trading avenues like DEXs, all these decentralized exchanges. So that's where also the price discovery is happening for Ethereum. for many other different assets. So I agree to your point that there can be maybe 20-30% could be a wash trading, or there could be this funny business happening. But I would doubt that it is impacting the market that much. Yeah.
Okay. Any other questions from the audience?
Jinesh, one question. Chetan MGR here.
Yes, please go ahead.
So Jinesh, thanks a lot, man. I think the analogies that you gave was really mind blowing, and thanks a lot. The question is, I want to get your view on. See, Defi, is it like only the last mile connectivity? Like, I have a Visa card with me. Okay, so I just go to a shop, buy some goods. Okay, so I insert the card into a machine. It just pays my funds in my account to the seller, right? So is it like DeFi is only limited? Let's say, would it restrict itself to only this scope, or is it like you think even it might be beyond this? Yeah. So what do you think on that?
I think DeFi will evolve into much broader ecosystem than what we are seeing. So my benchmark is something similar to the physical world. So in physical world, the banking system has evolved from let's say basic lending and borrowing to even home loans. And home loan is just in India, home loan is 30-40-year-old product. It is not that old in India. HDFC was the first one who came up with the home loan product. So something similar will also start happening on a Defi space. There will be there will be all kind of products which are available in a physical world, which will be available on a Defi space. Home loan is one of the things. That can be other products like mutual funds, insurance, and even credit cards. So credit cards with anonymity is something which is I read about it. Someone is working on it. So yeah, and we have seen that is already providing uh, funding for a lot of IPOs. So this is similar to IPOs. Like Instagram didn't wait to come up with an IPO and all those things. They directly went with an IPO.
Thanks, Jinesh. I think looking forward for the home loan. At least it would help me.
Yeah.
Good. Thanks.
Thanks.
Okay, from the chat, there were a couple of questions. Maybe it is beneficial for everybody. There was one question asking about what is yield farming. Either Jinesh or anyone from the group who has more knowledge on yield farming, you can spend 2 minutes explaining it.
Maybe Drew can take it.
Yeah, Drew or Karan, I think.
Hello, everyone.
Hi.
Hi, Dhruv here. So, yeah, yield farming. So, you supply two assets like Ethereum and USDT or two stable coins, and what you get in return is another coin, right? This is simply the yield farming. But for yield farming, there is a concept of impermanent loss. Like you have to supply both the assets in 50-50. Okay. So if the price of one asset goes up, then protocol will arrange the prices accordingly, and yeah, one might lose value. So but yield farming with two stable coins, I mean, it is safe if you are using a platform like Yarn Finance or something like that. And it is very important to use audited platforms, like for say if you want to like borrow and lend, please go to Aave or Yarn Finance. And yeah, if you want to do yield farming, Uniswap also is better. They are improving. So yeah, that is a yield farming. You get another coin by supplying your assets.
Thanks, Dhruv.
Yeah.
Okay, and I'm just checking. We talked about the IPFS. MGR asked the question, and also there was one question about on cross-chain messaging. Is it possible, or can we expect it soon? Like ADA DeFi is talking to ETH DeFi or Polkadot DeFi. So maybe Dhruv, you can answer this question as well.
Come again, Chetan.
Yeah, this is about a question about cross-chain messaging or cross-chain integration. Like Ethereum applications talking to ADA network applications or Polkadot and so on and so forth.
I mean, right now it is not possible, but you can move your assets from one chain to another through Binance or Trust Wallet, and yeah, you can use different chains, but you cannot directly jump from one chain to another. Okay.
Mm-hmm.
Yeah, so that is a work in progress, but with Trust Wallet and one can deploy multiple chains on MetaMask. It is easy. It is not a big deal, I would say.
Yeah, and also when we talk about direct integration, mostly probably we can see Kusama and Polkadot network talking to each other, though they are two separate networks, and mostly they have multiple people working on both the products or both the networks. We can expect them to talk each other sooner than any other networks.
Right.
Yeah. At least Chetan, what I read was the main value proposition of KSM. I think Kusama was it will come up with this. I mean, the central chain is the relay chain, which is sitting on Polkadot. On top of it, it will have some other chains called para chains, and then para chains will have bridges. Like recently OCC announced a bridge between ADA and Ethereum using OCC tokens. So it will be like multiple para chains will communicate to the central Polkadot network, and finally this network will have bridges which can cross cross integrate with incompatible blockchain networks like ADA to DOT or Ethereum to BTC, something like that. So this is, I think, work in progress probably.
Yeah,
as Dhruv
maybe.
said. Yeah.
Okay, so one more generic question. We have heard about this yield farming, and also we heard about the liquidity pools. Jinesh, maybe a little bit more details on liquidity pools, how it happens, how one can provide the liquidity pools. What are the risks here in this topic?
Liquidity pools are essential part of automated market maker, or what we call DEX, decentralized exchanges. So our normal exchanges like BSC and NSE or NYSE or Nasdaq are order book marketplace. So when you call order book marketplace, everyone puts their order in the order book. So if I want to buy Infosys, I will put an Infosys buy order, and it will be matched against the sell order of an Infosys. So here, what we don't see is that there might be n number of market makers, human market makers, who will put their bid and ask, which is similar to a Western Union. So when you go to a Western Union, you will always have a counterparty to do a trade at a. So they will offer you both bid and ask for both the currency. So here, liquidity providers are something similar to a counterparty. So here, n number of anybody can become a liquidity provider, and all of them will compete for a best price and best execution, which is not available in, let's say, Western Union. Western Union is the only counterparty with whom you are dealing with. But when it comes to automated market makers or decentralized exchanges, there can be multiple liquidity providers at different rates. So, but the trade will get executed only at the current rate or the best available rate for the best available quantity. So yeah, that's how the liquidity providers operate. They supply both the assets, as Dhruv mentioned. You have to supply, let's say, if you are providing liquidity for Ethereum and USDT, you supply both Ethereum and USDT in the same quantity and in the same value. So if you are providing one Ethereum, which is let's say $2,000, you have to provide $2,000 of USDT. So whenever some trade happens, whenever Ethereum to USDT or USDT to Ethereum transfer happens, there is a fee charge which is around 0.3% on 0.03% on Uniswap, which is passed on to the liquidity providers, which is their profit. And if the price moves in a big swing, so instead of $2,000, Ethereum goes to $6,000 or it goes to $500, there is a concept called impermanent loss. So that is a bit technical to understand, and it is something which any liquidity provider has to keep a watch on. Yeah.
Thank you, Janesh. Okay, any other questions?
Hi, Dinesh. Just one question regarding the Thor chain. We can use that with MetaMask, right? Or one needs a different wallet?
I think there is an option for MetaMask, but I haven't tried it. Yeah, most likely it should be possible. And I before this presentation, I was experimenting with it, and I saw an option for MetaMask. So yes.
Okay. Okay. Thanks. Looking forward to use that.
Okay, maybe the last call for any more questions from the audience. If not, a disclaimer, this was only for knowledge purpose. There are no any recommendation or suggestions financial advisors here for any investment. Please be noted, crypto is still in primitive stage. It's very volatile. You know, there is a huge risk of losing all the money in this space. Do your own research, do the analysis, understand the space, and then do the investment according to your risk management strategy. Jinesh, thank you very much for a wonderful session, and other participants, thanks for your active participation. Maybe you can say a few words, Jinesh, and then we can conclude this meeting.
Yeah, looking forward to having more similar sessions on different topics, ranging from mining to technical capabilities of other chains like Polkadot, Internet ICP, what was the new chain, Solana. So yeah, a lot of interesting things coming up, and I think the best way to keep up with all this innovation is to have sessions like this and to exchange knowledge. Thank you.
Yeah. Thank you all for your time, and maybe we can end this call now. Have a good day.
Bye. Thank you.
Thank you.
Thank you. Have a good day.
Thank you. Thank you. Have a good day.